Hi gentlemen, in this video we are going to unpack the stock market and how that is related to the price mechanism of demand and supply. So by the end of this video, you should be able to know what the stock market is. That includes what are shares. You'll know the operation of the Australian Securities Exchange, as well as being able to understand the different movements and shifts in demand and supply relating to the market for stocks. Okay, the stock market. So I think most logically, let's start by actually looking at what is a stock market. Now, to do that, we actually need to trace right back to looking at an example of a business that eventually makes its way onto the stock market. Okay, so let's go with that. Here's our story. Okay, let's start with a sole trader, this little dude here. And this little sole trader has come up with a new product, which is a new type of cola. There we go. Now, our sole trader has come up with this new product. It's fantastic. It tastes great. It's going to leave Coke and Pepsi in the dust. It's just a fantastic product. Now, this sole proprietor, this sole trader, this individual with this business idea is going to need a hell of a lot of money to get their business up and running, okay, in order to mass manufacture and compete with the big guys. So, what does our sole trader do? Our sole trader will first most likely approach a financial institution. Okay, they'll approach a bank. Okay, there's a bank which hoards billions of dollars of money, and the bank is willing to dish out some of this money, for at an interest rate to our sole trader. Okay, now the bank will weigh up its options. It'll look at the risk of the business to decide how much to lend and at what rate of which to lend the money. Now, our sole trader will take the loan and use that money that they've received from the bank in order to expand their business. So our sole trader might use that money to build a small factory. Okay, here we go. Pretend that's a factory, all right? So now they're using the loan, they're mass producing their cola in their factory, but they're probably supplying locally or domestically at this stage. Okay, but nonetheless, they're producing a hell of a lot more cola than they were before they had access to this money, to this capital. Okay, so off they go and they're producing stuff. Now, every time they sell a can of soda, they're making sales revenue, which is awesome. So they've got money from the bank and they've got sales revenue, which is all flowing into the business. Now, this is great. But our little sole trader here has big dreams. The sole trader wants to own a multinational corporation one day. They want their product in every supermarket around the world. Now, if they're just relying on loans from the bank or sales revenue, it's going to take probably decades for our sole trader to build up their business to the scale which they desire. So we need another source of revenue. What do? Well, we can now approach investors. Okay, so investors. Here we have some more people that have money and want their money to work for them. They're looking for a passive income stream where the investor can simply hand over their money to the sole trader in exchange for part ownership of the business and therefore part distributions of the business's future profits, for those distributions to flow back to the investor. Now, this is called, equity financing. The investor will own equity in the business, ownership of the business, in exchange for a percentage of future profits to go back to the investor. So now we have money from the bank, money from sales, money from investors. This increase in capital inflows into the into the business allow now for several more factories to be constructed. Okay, now we've got several factories around Australia. We've got maybe now we actually might have some factories overseas as well with these 3 different revenue streams. Okay, from the bank. Well, I wouldn't say from the bank is revenue, but monetary streams from the bank, from sales, from investors. Okay, the business is growing. But once again, we are confronted with relative scarcity in the sense that the sole trader is now actually a partner. He's now partnered with the investors, and they want to grow the business even more, to all different countries across the world. It will take many years to do this. So we have really one option left if we want to see major expansion in the business, and that is to take the company public. Now, right now, this is a private entity, okay? It's really just now it's a partnership, but it's a self-contained entity. It's a private entity. To take this business public means that we're now going to list it on a stock market. So we're going to take this business with all its assets and everything it does, and we're going to try and float the business on the stock market. The concept of floating is when the new business first lists on a stock market. It floats its shares. Now, how does it do this? Well, first off, the stock market will evaluate whether this is a solid business or not, whether you'll have to meet like an asset test, and it'll be scrutinized heavily. So they'll want to delve into all the financial reports before they get approved to be floated on the stock market. But when you float on the stock market, what you're basically doing is you're taking your business. I might just do a pie chart here. So this is your business, right? Pretend that's a circle. Okay. And the partners are probably going to want to hold on to about 51% equity or ownership of the company. Okay, they're probably going to want to hold on to 51% themselves. The remaining 49% is going to be floated onto the stock exchange. Okay. So here you see different proportions of the company. Now, other random investors, these could be mum and dad investors at home who have a bit of savings and want to put it somewhere. So this is the mum and dad investors. There you go. It might be investors that are businesses, like it could be a superannuation fund. Okay. Like Care Super, those ads where everyone's trying to make a nest, like an egg with their hands. Care Super. That's one example. So superannuation funds are businesses that basically they're receiving money from people's paychecks and they're holding that money for them for when the person retires. But they don't just hold the money, they invest the money, okay? And what are they going to invest in? Well, they might invest in some shares. So the super funds might be buying some shares in this new cola company as well. Other banks like NAB, ANZ, Westpac, whatever, other banks are hoarding billions of dollars worth of savings, and they're not just going to sit on it, they're going to invest it. So there's individuals and businesses who are sort of, they've got the feelers out there. They're thinking, where are we going to put our money? Well, this new cola company has just floated on the stock market, and they'll all start to buy proportions of this business. Okay. They're now shareholders because they hold a share of the business. Okay. Now, every dollar these shareholders are spending to purchase newly floated shares or stocks, we'll call them shares, in this company, every dollar is going back to the business. So let's say that this cola company decides to float, hypothetically, $10 million worth of shares, then they've just made $10 million worth of revenue from the sale of shares on the stock market. This business is now $10 million richer. So there's a huge incentive to take your company public and put it on a stock market because the sale of shares brings in immediate finance without the need to sell anything, to sell any product, without any need to sell any product. What you are selling is a proportion of your business. Now, just like our investors were eligible to receive a proportion of future profits, shareholders are now also part owners. So shareholders are also entitled to a share of this business's profits relative to the share they own. The larger the share, the more you get. Okay. Now, the share of future profits is known as dividends. Okay. Dividends, it's a distribution of profits back to the shareholder because they own part of the company. Okay. So that's how, I guess, businesses go from being private entities and how businesses then interact with the stock market. So then taking this knowledge of the basic sort of, I guess, way in which businesses operate with the stock market, let's look at the stock market in more detail. So the stock market, I guess, by definition, is the market that involves an auction of securities. I'll explain this in a second. An auction of securities such as shares, but there's other things too. We'll talk about debentures, and bonds. Okay, so a market, you have buyers and sellers. What are we buying and selling? Okay, we're selling different types of securities. Okay, securities, that's a key word. Now, a security just means a tradable financial asset. Okay, so there are different types of financial assets, investments that you can trade. The most common one is, of course, shares. And I think it's something like, 36% of Australians are shareholders. Okay, 36% of the population owns shares. So that's a common security. Okay. Now, it makes sense that we have a central place or a central market to buy and sell all these. You know, it's our stock market. Then we have debentures and bonds. I'm just going to skip to bonds. You can have treasury bonds, but you can also have corporate bonds. Now, what they are briefly is a treasury bond is the investor buys a bond from the government. Now, why do you do that? Why are you giving the government money? Well, you get a bond from the government, which is like a certificate, a piece of paper, which says you've given the government this amount of money and it's for a maturity of 10 years, for example. So that means you're going to get all your money back after 10 years once the bond reaches maturity. Okay, so you get all your money back, big deal. But the bond also has a coupon rate, an interest rate. So you're going to get all your money back at maturity plus interest, which is the coupon rate. All right, that's a bond. Now, the government sells bonds because they're desperate for money. So during wartime or during financial hardship for a country, they'll try and sell more bonds with a more attractive coupon rate, a higher interest rate. Now, these bonds, I don't want to hold on to a bond for 10 years. I mean, I've seen 30-year bonds. I think there's even 50-year bonds out there. I'm not going to hold on to them for that long. I'm going to want my money at some stage, but it's not maturity yet. So I'm going to sell them to another investor. How am I going to find that investor? I'm going to put my bond on the stock market. Okay. Corporate bonds work the same way, only it's not a bond with the government, it's a bond with a business. So technically you could buy a corporate bond with Telstra. That's not shares. You're not buying a share in Telstra. You can buy a bond with Telstra, which works the same way in the sense that you sort of get that piece of paper, which has a maturity, and the corporation will pay you back the money plus interest. You're not a part owner, you own the bond, okay, which you can trade. So I'm not going to get into debentures because you don't need to know. So that's the stock market. Now, Australia's stock market is called the ASX, which a lot of people don't label this correctly. The acronym ASX actually stands for the Australian Securities Exchange. Okay, a lot of people think it's the Australian Stock Exchange. It's not. It's the Securities Exchange because you can trade a lot of securities. Okay, not just shares, bonds, and all sorts of stuff. Okay, just there's heaps. So there's our ASX. Now, most securities are traded on the ASX. Are there some other trading platforms? Yes, there are. Okay, this is a competitive marketplace, but most of them are on the ASX. And often, the buyer and the seller of shares, for example, will go through an intermediary third party known as a stockbroker. Okay, usually. Right, so here we have, for any market to operate, we need buyers and sellers. Okay. Now, a lot of this is done electronically now. It used to be that you physically had to call up or, get in contact with your stockbroker. A lot of the time now, you can do this electronically using the use of an electronic stockbroker. But nonetheless, I might want to buy shares. I might demand shares. There might be someone out there who's willing to sell their shares. Okay. It usually goes through some sort of stockbroker, which will charge some sort of brokerage fee. Okay. Which depends who you trade through. I think it's with the ASX, roughly between $10 to $20 of brokerage. Okay. To pay for that person who's going to help facilitate the trade in the marketplace. So what you've got here is a basic overview of the stock market in general. But now we need to look at the price mechanism of demand and supply and what that looks like on this particular market. So let's have a look at the price mechanism. Like always, we're just going to sketch out supply and demand, price and quantity are always our axes, and now this is the stock market. Okay, we have demand always sloping in that direction, and we have supply sloping in the other. Okay, now at equilibrium, we have a situation where buyers and sellers are content to trade. Okay. So at this price and at this quantity, people who are looking to sell their shares are happy to sell them at this price People looking to buy shares are happy to buy them up because they think it's value for money. Okay. Now, why are people selling their shares? Well, it's probably because their shares have appreciated in value. Their shares have gone up since they bought them. And when you sell shares for more than you bought them, you're getting capital gains. Okay. That's, I guess, the profit on selling an asset for more than you purchased it for. You're selling it for capital gains. Okay. So here we go. Let's say the price of shares were for whatever reason were to fall. Okay. Now, if prices of shares fall, it's generally because of some sort of external pressure. Something's happened. Okay. But notice, this is interesting. The price of shares has fallen, yet demand has gone up. If we have a look here, this movement in demand is still, like it always is, this movement in demand is an expansion. As now we no longer demand Q1, we demand Q2. Now, why is it? These shares aren't doing well, but we want to buy more of them. I guess the logic is these shares are now at a bargain price. I think that's the idea. The idea is here's a good company that is going to make dividends over time. It's going to pay out dividends over time. It will bounce back as well as market conditions improve. But right now, the share is at a bargain price. We can afford to buy more of them. So even though the value of the shares are dropping, now is the perfect time to buy them because now they're cheap. Okay. By the same logic, if the price of shares were to increase to price 3, we will see a contraction in demand because quantity demand drops. Okay, quantity demand is going to drop. So that's a contraction in demand. Because now the shares, they might be doing really, really well, but they're too expensive. Okay, we've kind of missed the boat there in the sense that we probably should have bought them earlier before they started skyrocketing, okay, in price. So there we have some movements, okay, in the stock market. But demand can also shift. So let's take that as let's look at that for a second. I might do it up here in the corner. So it's once again take the stock market. We have price and we have quantity, like always. And demand and supply. Now, let's say something in the market happens, like, okay, I'm going to take the coronavirus because it's all over the news at the moment. And there's a particular pharmaceutical company that publishes it is days away from a vaccine. And this pharmacy is listed on the stock market, this pharmaceutical company. Now, demand for shares for that company are going to absolutely explode as now we are willing and able to buy more shares in that pharmaceutical company. Now, what we actually see happening here is the increase in demand is forcing the price of shares to go up. So the price is going up, yet we are demanding more shares. This is not an exception to the law of demand. This is not an exception. It's simply a shift in demand. Demand has shifted. We're now more willing to pay more for these pharmaceutical shares because we believe that the company is going to be incredibly profitable because it's about to come up with a vaccine. Okay. It is future expectations that will result in a shift in demand for the stock market. So this company's coming up with a vaccine. It's our expectation that we believe that the company will now do better in the future. It's based on what we believe. That causes the price of shares to go up or down. If we think a company is going to do really badly, then that'll lead to a decrease in demand, a shift in the opposite direction. So that future expectation of a company doing badly would look like this. Okay, demand would drop, demand would decrease. Right, we go in this direction, lowering the price of that share. Okay, demand is what drives share price. Okay, it's actually got surprisingly little to do with the profitability of the business itself. I mean, that's the fundamental. But what really drives share price? It's demand. Demand driven by our future expectations of that company. That's what drives the share price. The last thing to look at now is the stock market and supply, because really we've been talking about demand thus far. Let's take one last graph. I'll just do it down here. Here's our stock market once again. The buyers and sellers for shares, and we have price and quantity. Here's our demand curve, and there's our supply curve. Now, supply. It is possible for supply of shares to change. It could be that more people want to sell off their shares. Okay. They might want to sell off their shares because they're happy with the profit they've made or they will make when they sell them. Or they might want to sell off their shares because we might be heading towards recession. And in that case, we want to quickly sell our non-cash assets and we want to cash in. We want that money just in case the market were to collapse in the future. Another way supply can increase is the businesses themselves release more shares. Okay, this is uncommon, but it can happen where basically they release even more shares in their company to get more sort of immediate revenue into the business. Okay, but it's a risky strategy because you have to pay more dividends. All right, so you've got to really think if you want to release more shares. But anyway, people are selling their shares, companies are releasing more shares. That's an increase in supply. Okay, there's our increase in supply. Now, unfortunately, the more people who want to sell their shares or the more companies that release more shares, they're actually damaging the share price. And we can see that when comparing the two different equilibriums, right? The price has gone from price 1 down to price 2. So the last thing we want is a run on the stock market, and a run on anything is people sort of just cashing out. You don't want that. It's going to result in an increase in supply, which devalues the price of stocks. Okay, and you can see that there. Now, that's led to more demand for stocks because the stocks are now cheaper, but they're now not worth as much. Okay, so that's supply. People selling shares, companies releasing more shares. So hopefully now you've got a pretty good, general understanding of how the stock market works and how demand and supply influence the price of shares on the stock market. Australia, using mainly the ASX, the Australian Securities Exchange. Okay. Like always, gentlemen, please refer to the relevant pages of the textbook and the PowerPoint slides. Please send through any questions you have through Microsoft Teams, and best of luck.